Imagine a small lemonade stand run by a girl named Jill. She's doing really well, but when she tried getting a loan from the bank, they worried it wouldn't be safe. Big investors also didn't want to join. So Jill decided to go public, letting anyone invest by buying a small part of her stand. This is what's called an IPO, or initial public offering. It allows people to own a piece of Jill's business by giving her money.
Now, when people buy a piece of Jill's stand, it's called a share. Sometimes Jill will give part of her earnings back to those who own shares. These are called dividends. The stock market is all about this. People buying and selling parts of companies. They hope these parts, or shares, will become more valuable over time. People love to invest in hopes that, like Jill's stand, profits will let them earn more later.
Let's talk about the New York Stock Exchange, often called NYSE. It's the largest stock exchange in the world and is based in New York City. It's been around since 1792, and it's where big companies sell their shares. When people think about the stock market, they often think of this place. It's where lots of famous companies trade their stocks. People from everywhere look at the activities here to get a picture of how the market is doing.
Now, there's another important place called NASDAQ. It's different from the NYSE because it doesn't have a physical trading space. Everything happens electronically. NASDAQ is known for technology companies. Companies like Apple and Facebook trade their stocks here. It's like the tech world of trading. Both NYSE and NASDAQ are at the heart of the American stock market. They are where most of the action in buying and selling shares takes place.
When we talk about tracking the stock market, we often mention something called indexes. One major index is the S&P 500. It watches the 500 largest companies listed on NYSE and NASDAQ. People look at the S&P 500 to understand how big companies are doing. A rise or fall in the index can show economic conditions. This index helps us see the overall health of the stock market. It's a key tool for investors and analysts everywhere.
There's another index called the Dow Jones, or just the Dow. It's more selective, looking at only 30 companies. These companies are considered very important and include giants like Apple. The Dow gives a glimpse into the economy, though it follows fewer companies than the S&P 500. Both indexes, however, are crucial for understanding the stock market's movements. They help people make informed decisions about their investments.
Before, many businesses were controlled by one person. Imagine business giants like Andrew Carnegie or Rockefeller. They made all the big decisions themselves. They were like the kings of their companies. But then, things started to change. Companies like General Motors wanted to grow faster. To do this, they became public companies. This meant they were selling shares to people, letting the public own parts of the companies. It was a new start for many businesses.
Going public was a smart move because it helped companies grow much faster. With more people owning shares, businesses had more money. This let them open new branches and create new products. Also, shareholders, or people who own these shares, can have a big influence on companies. If they think a business is making bad decisions, they might sell their shares. This can cause the share price to fall. It keeps businesses on their toes and thinking hard about their choices.
After World War II, the American stock market played a big role in building new wealth for everyone. This was a time when people believed they could really get ahead. Companies started to sell shares to more people, not just the rich. This helped regular Americans have a chance to invest their money and build wealth over time. With more investments, businesses grew bigger, providing more jobs and boosting the economy.
Public companies did a lot for the middle class. They were not just for the rich anymore. With shares open to the public, these businesses could grow faster. Jobs were created, products got better, and the economy thrived. People like Warren Buffett understood this well. He is famous for looking at the value of companies carefully, choosing to invest based on long-term growth. This way, even regular people could benefit from the stock market if they invested wisely.
In the world of the stock market, it's interesting to think about how people pick which companies to invest in. John Maynard Keynes, a famous economist, once shared an idea that's quite clever. He said, instead of just choosing a company you think is great, you should think about what everyone else will find great. This is because the stock market often moves based on public stories rather than just facts.
An example of this can be seen with Chipotle and Volkswagen. Chipotle's shares dropped when health problems were linked to their food. For Volkswagen, A scandal about its emissions made its shares drop too. But what happens when stories are not right? In the past, people thought internet companies would take over, even if they didn't make a profit at that time. This belief was so strong, but not always true.
Investors often follow these stories because they can cause share prices to rise or fall quickly. In the 1990s, many tech companies were talked about as if they were the future, and their stock prices went very high. But when stories do not match reality, it can lead to big problems. This is what's interesting about the stock market. Sometimes it's about believing in something that many others believe too.
You're right. These stories can sometimes lead to bubbles where prices rise too high and then crash. This shows how much power public opinion has in the stock market. It's like a game where everyone tries to guess what everyone else is thinking. When the stories are good, everything can seem wonderful. But when reality hits, it can be tough. This is why understanding both stories and realities is important for investing.
Let's talk about stock market bubbles. A bubble happens when people get too excited about investing, thinking prices will keep going higher. At some point, prices go too high and cannot be kept up. This usually leads to a crash where prices fall hard. A good example is the dot-com bubble in the 1990s. During this time, many people invested in internet companies hoping for big profits.
When this dot-com bubble burst, the economy felt it deeply. Many companies failed, leading to the loss of thousands of jobs. This collapse made people understand the risks involved when prices rise too fast without real value. Not only investors suffered, but the whole economy had to recover from the fall. It shows how important it is to have a stable market and to not get caught in the excitement of fast gains.
The burst of bubbles leads to more than just losing money. Companies can go out of business and workers can lose their jobs. During the dot-com crash, many tech companies disappeared, and people had to find new work. These kinds of events make everyone cautious. If the market goes down, it takes time for everything to get back to normal, affecting people's lives and businesses too.
It's true. The economic impact is wide. When many people had jobs tied to these tech companies, their loss meant less spending, affecting other sectors. Restaurant owners, shopkeepers, and even places outside the tech world felt the hit. This is why a balanced approach to investing and understanding real company value is so important. We have to learn from these events to build a better, more stable future for everyone.
Milton Friedman, an important economist, had a strong opinion about companies. He believed the most important thing for a company was to make money for its shareholders. This viewpoint led to executive pay becoming linked to the rise and fall of stock prices. CEOs were given a lot of money if the company did well in the stock market, which often meant looking at short-term profits.
This focus on quick profits can be a problem. It sometimes means not thinking about long-term plans like helping workers or making new products. A good example is Wausau Paper and the Brokaw Mill. When some investors wanted fast returns, they pushed the company to close its mill, leading to many people losing their jobs. It shows how focusing too much on short-term gains can harm people in the community.
Please remember to like our podcast if you enjoyed this episode. Your support matters. We'd love for you to subscribe so you never miss an update. Also, we're eager to hear from you. Drop a comment or suggest topics for future episodes. Your ideas help us make the content you want to hear.